We're just starting. I mean, we just got to the starting point. This is like, we're barely scratching the surface.
Hi, Gil.
Hi, Jan. How are you?
I'm very good, thank you. And it's a real pleasure to be here today with you. And from a VC perspective, there's so many startups in consumer finance, insurance, but there's been really terribly little in capital markets. I would love to hear kind of what led to the birth of this idea.
Sitting within the center of this industry as the financial crisis was happening, it was quite shocking to see how the world is really unraveling. And the regulators stepped in with very meaningful limitations that made to reduce the systemic risk of the banks and the domino effect. And they made the world safer. And they've done an amazing job. But what you have is, on the one hand, safer banks, but we started seeing in 2009, 10, and onwards, we started seeing the implications. And the implications was just that there was not enough banking capacity to provide the services that the industry needed. I was thinking about, well, how do we solve that? While this was happening in the Silicon Valley, you start seeing companies like Airbnb, like Uber, the whole sharing economy, started taking off. And it was a model that was just so exciting. And the whole notion was there is all of this spare capacity elsewhere in the industry, apartments, cars, everywhere we go, there's just spare capacity that if you just connect the two, you could unlock huge value.
So how does it really work? I mean, we do know how the stock exchange works. How does your solution work?
Let's assume that a corporation wants a standby loan from a bank. Pre-crisis, not a problem. It was an off-balance sheet item. And basically balance sheet didn't cost much. Not a problem, we'll give it to you. Life is great. Post-crisis, you need to put it on, the banks need to put it on their balance sheets. And B, the regulators created wisely a mechanism whereby the most expensive cost of capital is for the largest bank in the world. And the bigger you get, you actually have to allocate more capital. So what happens is, it's from a balance sheet perspective, it's very expensive for them to do, actually non-economic. At the same time, asset manager 123 loves the risk, but doesn't have access and doesn't know how to underwrite it. And the platform is a combination of bits and bytes technology, as well as financial technology. Just like Airbnb, you're connecting this buyer and seller.
The regulator is not worried that capital is too distributed, or is that in fact desired?
We believe the responsible market response to what the regulators wanted. We're helping to actually continue shrinking the banks, but we are bringing tons of additional capital. We know that now that we've implemented that, the results have been far better than what we ever expected in terms of the benefits and in terms of the desire of both sides and the willingness to work together.
And could you reveal who were the first clients who took a chance on you?
I would say on the sell side, it was Citigroup. And then very shortly thereafter, it was State Street. And very shortly thereafter, it was JP Morgan. They believed in us, and they also saw our execution of what's happening. And all three, as we've announced, became strategic investors last summer.
Could this marketplace democratize access to other players, including corporations or other types of non-financial players?
If you're an institution that manages capital, you could participate and you will participate in this market. And in fact, with the product that we already launched, which is the financing of equity total return swaps, within the first 4 months, we were pleasantly surprised to see that a very well-known technology corporation is an investor, a provider of some bank balance sheet.
Give us a sense of the size and impact of the company.
Overall, as an industry, we've reduced about $8 trillion of overall positions. We have about 75 clients. By the end of this year, we'll have over 100. And the nice thing is, with every one of our clients, we started with one product. People started one place, but by now, The bank that uses us the most is using 7 of our products and is working with us on additional ones already. So we've been really expanding within those institutions as well as adding additional clients.
What's the ceiling to this? You sort of describing what is still relatively early days.
Oh, it's like, people ask me, what is the size of the universe? I don't know how to size it. It's big. The banks have infinite ability to originate and process business. But from a capital perspective, for almost anything they do, there is cheaper and available capital elsewhere. And the beautiful thing about this huge industry is that every segment we're talking about in trillions of dollars, with a T, right? So it's a huge market. So what is the dream? The dream is that the largest banks become fintechs themselves. Every institutional client in the world will have access to the best services that are out there, but we're going to do that while reducing the systemic risk of these banks. And how do you do that? You use capital from basically every institutional investor on the planet.
Could you talk a little bit about sort of the profound changes to the economy? What would you foresee is the societal impact?
Having a safe, trustworthy system that's reliable and stable and just is at the core, to me, of democracy, of the free world. We thought a lot about this. We think this is the only solution. This approach is basically reimagining, rethinking the capital markets or the future of capital markets in a fashion that will help it be both safe, healthy, growing, vibrant, with access to all. So we're very excited about the journey ahead and continuing to grow together.
Likewise. Thank you.
Thank you, Jan.